So let's look at inventory payables. Now, when you first bring in your historical inventory payables balances into your financial model from your accounting package, this is brought into your historical balance sheet located below your creditors within your current liabilities section. Now, as you can see in this example, we have one category of inventory payables titled inventory payables, and we have the historical balances on the right-hand side of the sheet. If we scroll across your time series until we get to our closing month of June 22, we can see that we have a closing balance of 2428.9. Now, when we forecast your inventory payables balances within your financial model, this is handled on your working capital sheet located below your creditors analysis. As you can see, we have one category of inventory payables with the opening balance of 2428.9 being brought through from our historical balance sheet. Now, as with our other areas of working capital analysis, there's a few moving parts within our inventory payables. So to start, I'm going to wipe everything down to zero so it's easier to step through each aspect. Now that I've wiped everything down to zero, we can see that our forecast inventory purchases coming from our inventory analysis are assumed to be paid in cash, and our opening balance of 2428.9 is not paid throughout the model. Now, our first assumption in column I is the period over which we assume we are going to pay off our opening balance of 2428.9. If we assume we're going to pay this off over a period of, say, 30 days, when I put my assumption in of 30, we can see then the entire balance is paid within our first forecast month of July 22. If we assume we're going to pay this over a longer duration of time, for example 45 days, you'll see that as I update our assumption to 45, the cash payments are then spread across July and August. The way this is calculated is we divide our opening balance, in this case 2428.9, by the number of days over which it is to be spread. Splitting this balance into 45 equal payments, we then have 31 payments occurring within the month of July, as we have 31 days in the period, with the remaining 14 payments taking place within August 22, representing the appropriate split between the 2 months. If we wanted to pay it evenly across the 2 forecast periods, we can then enter an assumption of 62, as there are 31 days in both July and August. Once we've updated our assumption to 62 days, you can then see that our cash payments are evenly spread. So that's how we forecast the payment of the opening balance. Now, when we forecast our inventory payables analysis, you can see that we're currently using a cash payment delay mechanic. This is very similar to how we forecast our creditors analysis, and if you want an explanation as to why we use a cash payment delay mechanic rather than a simple days terms mechanic, I'd suggest you go and watch our creditors video for a quick explainer. So that we have forecast numbers to work with, I'm going to allocate our CocoBix forecast inventory payables into the analysis so that we now have numbers flowing through. As you can see, as our cash payment delay is currently set to 0 days, we're assuming that all purchases are paid in cash, and that's why we still have a 0 balance on our inventory payables month to month. If we look at September 22 as our example, we can see here that we're forecasting purchases of 646.9, which is coming from our allocation above, and with our delay of 0, our payments equal our purchases. Now, the way our cash payment delay works is we assume that our inventory purchases for any month are spread into invoices of equal amounts, with one being received every day of the month. Using our example of September 22, as there are 30 days in the period, we assume that our 646.9 of purchases are spread evenly across 30 invoices, with one being received each day of the month. After a certain number of days, that being our cash payment delay assumption, each invoice is then paid. For example, if we assume a delay of 30 days, when I enter our assumption, you'll see that we then have the entire balance being paid off in the next month. That is, each invoice sent out in September is paid consequently in October. The invoice received on September 1st is paid 30 days later on October 1st. Then the invoice received on September 2nd is paid 30 days later on October 2nd, and so on. If we pay our suppliers on longer terms than this, say for example 45 days, updating our assumption, you'll then see that the cash payments are spread across October and November. In this case, the invoice received on September 1st is now paid 45 days later on the 16th of October. Following this forward, we then have 16 payments occurring within the October month, with the residual payments then occurring within November. As there are 16 payments occurring within October and 14 payments occurring in November, this is why we have a slightly differential split. If we updated our assumption to say 46 days, so that we had 15 payments occurring in each month, we can then see that we have even payments occurring between October and November 22. If we then applied this 46 days assumption to the entire forecast of our inventory payables analysis, we can then see that the entire analysis comes to life. Each month we have our opening balance pulling in our inventory purchases which come from our inventory analysis. We then have a calculated cash payment representing the payment of invoices, in this case received 46 days prior, as well as the adjustment for invoices received in this period which will then be paid 46 days later. This then calculates our closing balance of inventory payables outstanding at the end of the month. If I were to update our cash payment delay assumption from 46 to say 50 days, as we assume that it will take us longer on average to pay our suppliers, this then results in a higher closing balance for inventory payables, as at any point in time we're holding on to a greater amount of invoices and we have a greater amount owing to our suppliers. When looking at the financial statement impacts of inventory payables within a full three-way financial model, if we use the example of $100 of inventory being purchased within a month, assuming we're yet to pay our suppliers, we would then adjust for this with an increase in our inventory payables balance within our current liabilities on the balance sheet. Our adjustment to our inventory payables balance is matched with an adjustment to the cash payments within the operating section of our cash flow statement. Hopping back to our example, if we want to see our closing balance of 1075.4 for inventory payables within the September 22 month, as well as our decrease in inventory payables of 25.9, we can head back to our table of contents and activate our financial statements. Firstly, looking at our balance sheet, if we head to our current liabilities section and expand our accounts payable collapse rows, we have our inventory payables section. And if we then scroll across our time series until we get to our forecast month of September 22, we can see our closing balance of 1075.4 in our current liabilities. Heading down to our cash flow statement, if we want to see our adjustment to our inventory payables closing balance, if we expand our cash payments section, down the bottom we have our inventory payables and we can see our adjustment of 25.9, reflecting the decrease in our inventory payables balance in the month of September 22. Now, when we look at inventory payables, it's important to remember that this is simply an adjustment to the balance sheet and cash flow statement and does not affect the profitability of a business. Inventory payables is an increase in our current liabilities section of our balance sheet, and this is matched with an adjustment to our cash payments within the operating section of the cash flow statement. This adjustment increases our change in cash held, which in turn increases our cash at bank. This matches our increase in inventory payables on our current liabilities section, ensuring that net assets and total equity are balanced and our balance sheet balances as well.